Hey guys, Sean here with The Modest Wallet. Things have been a little shaky with the economy recently.
It's a little bumpy.
If you're worried about the stock market correcting, then you will want to consider the following exchange-traded funds, ETFs, that I'll be discussing today. More specifically, we will take a look at 7 Vanguard ETFs to buy for the 2022 recession. First and foremost, this is not financial advice, so please do your own research. If you do find some value in this video, smash that like button to help us out with the YouTube algorithm. So as you know, we're going to be talking about Vanguard ETFs, which you can literally buy on any brokerage platform, so you don't necessarily have to just buy it from a Vanguard exchange. But if you know anything about Vanguard, you know that they are known for their ridiculously low cost expense ratio ETFs. Now I do realize that some of you may have no idea what an expense ratio is. It's the annual cost or fee for owning a fund, and when you own Vanguard funds, you pay close to zero in costs. Seriously, these things are much lower than the typical ETF. And if you don't know what an ETF is, we previously did a video explaining all about it, so I'll link it above for you to check that out. Now, if you do have any questions regarding any of this, please let us know in the comments below, and we will do our best to get back to you as soon as possible. All right, guys, let's get into it. First on our list of the 7 best ETFs to buy during the 2022 recession is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. As inflation takes a bite out of household earnings power, the Dividend Appreciation ETF has suddenly become one of the best Vanguard ETFs to buy. This fund tracks the performance of the S&P US Dividend Growers Index. What that means is that it's designed to measure the performance of US companies that have followed a policy of consistently increasing dividends every year for at least 10 consecutive years. As of August 5th, 2022, this stock was priced at just under $154, and it is down 9.5% year to date. In other words, that means since January 1st, this ETF price has decreased 9.5%. On the other hand, since the fund's inception, or when it started, it has performed rather nicely, coming in annually at 9.31%. Now, 289 stocks make up this fund, with consumer staples, financials, healthcare, industrials, and information technology making up more than 75% of the fund. To break that down even more, here is a list of the top 10 holdings for VIG, with United Health Group, Johnson & Johnson, and Microsoft as the top 3 largest positions. As with any fund or stock, the dividend yield changes based on the price fluctuating up or down, so you can see the dividend per share on the screen the fund pays out each quarter. The expense ratio is 0.06%. Now, if you have no idea what that means, let me put that into perspective for you. For every $1,000 invested, you would pay an annual fee of just 60 cents. Second on our list is the Vanguard Energy ETF, ticker symbol VDE. This is an investment appropriate for our times. This energy ETF can help turn the soaring costs of energy a bit in your favor. The Vanguard Energy ETF seeks to track the performance of a benchmark index that measures the investment return of stocks in the energy sector of the stock market. The fund includes stocks of companies involved in the exploration and production of energy products such as oil, natural gas, and coal. So on the screen, you can see the current price of VDE as of August 5th, 2022. Now, this fund is definitely not on discount today because of energy prices, but it is a top performer year to date, with returns up over 34%. Since inception, or when this fund started, VDE averages just over 7% returns annually. VDE is comprised of 109 stocks, with integrated oil and gas making up 42% of the fund, and oil and gas exploration and production making up over 29% of the fund. VDE's top holdings are included on the screen, with ExxonMobil, Chevron, and ConocoPhillips rounding out the top 3 companies. The dividend yield has produced some nice quarterly dividends, going over $1 in the most recent dividend payout per share. As you can continue to expect, the expense ratio is very low, The expense ratio for VDE is 0.1%, so for every $1,000 invested, you would pay $1 annually. Coming in at number 3 is the Vanguard Consumer Staples ETF, ticker symbol VDC. With household budgets under fire due to inflation, more attention will be paid to the essentials, thus benefiting the Consumer Staples ETF. This fund seeks to track the performance of a benchmark index that measures the investment return of stocks in the consumer staples sector. It includes stocks of companies that provide direct-to-consumer products that, based on consumer spending habits, are considered non-discretionary. We're talking about things like food and beverage, household goods, and hygiene products, as well as alcohol and tobacco. The year-to-date return is negative 2.8%. Since inception of the fund, it returns an average of 9.88% annually. The fund started in 2004. VDC is comprised of 101 stocks, with its top 3 holdings including Procter & Gamble, Coca-Cola, and Pepsi. It's no surprise that household products, hypermarkets and supercenters, packaged foods and meats, as well as soft drinks make up the greatest percentage of this fund. The dividend yield is quite healthy, as you might expect with consumer staples companies, and you can see that the latest quarter's dividend paid over $1.20 per share. As with VDE, the expense ratio comes in at 0.1%, meaning that for every $1,000 invested, you pay $1 in annual fees. Fourth on the list of Vanguard ETFs to buy for the 2022 recession is the Vanguard Total Stock Market ETF, ticker symbol VTI. This broad exposure ETF can help diversify your portfolio, and a more diversified portfolio is generally more protected against market downturns. Even if several of the stocks in the fund don't survive a market crash, the vast majority will. VTI seeks to track the performance of the US Total Stock Market Index. This includes large, mid, and small cap companies, which creates diversity among growth and value stocks. VTI is down 13.35% year to date. As we know, stocks in general have not performed well in 2022, so this decrease makes complete sense. With that said, the 3, 5, and 10-year annual returns have been very positive and what you want to see in a total stock market index. There are 4,098 stocks that make up this fund. It is fairly balanced among the different stock market sectors, with technology leading the charge at a little over 25%. Apple, Microsoft, and Amazon are among the greatest percentage of holdings in the fund. VTI has a steady dividend yield and has produced a nice, fairly consistent dividend each of the last couple quarters. The expense ratio is an incredible 0.03%. That means for every $1,000 invested, you would pay 30 cents annually. All right, at number 5 is the Vanguard S&P 500 ETF, ticker symbol VOO. This ETF is designed to mirror the performance of the S&P 500 index itself, making it more likely to survive market volatility. The S&P 500 has experienced countless ups and downs over the years, yet it's always recovered from even the most severe crashes. So in case you didn't know what the S&P 500 was, we're talking about 500 of the largest US companies. With that said, this fund is a nice gauge of the overall US stock market returns, offering a high potential for investment growth. Now, year to date, VOO is down 12.25%. Since the fund's inception in 2010, it has returned over 14% annually. Those are the type of returns I love. There are 503 companies in the fund with a nice mix of the different stock market sectors. Information technology comes in at over 26%. There's no surprise that once again, Apple, Microsoft, and Amazon are the top 3 holdings in the fund. VOO and VTI are probably your most popular Vanguard funds. Not only do you get some solid growth with this fund, it has produced a considerable dividend yield, which has paid anywhere between $1.30 and $1.50 in that range in the last couple quarters. Just like VTI, the expense ratio is 0.03%. Always love to see that as well. Next is the Vanguard Total World Stock ETF, ticker symbol VT. While it's usually best to stay in the domestic realm, exposure to the total world stock market ETF can broaden your portfolio's horizons. This fund invests in both foreign and US stocks. It invests in both well-established and still developing markets. There's a high potential for growth, but also some risk involved. Year to date, VT is down over 14%. Since the inception of the fund in 2008, it has returned 6.65% annually. There are a whopping 9,454 stocks inside of this fund. The majority makeup of this fund is North America, with more than 62% of companies from there. Emerging markets, Europe, and the Pacific have some major influence as well. Apple, Microsoft, and Amazon, for the third time in a row, round out our top 3 holdings of this fund. On the screen, you can see the dividend yield as well as the most recent quarterly dividends. The March payout is a little lower than the rest. I'm actually not sure why. The expense ratio is still great, but a little more than VTI and VU. It is 0.07%, meaning that you would pay 70 cents for every $1,000 invested. And last but certainly not least, topping out our list is the Vanguard Large Cap ETF, ticker symbol VV. With a healthy mix of blue chips, this large cap ETF is one of the best Vanguard ETFs to buy for stability and reasonable growth. This fund tracks the performance of the US Large Cap Index. It provides a convenient way to match the performance of a diversified group of stocks of large US companies. Like most of the ETFs we've mentioned, this fund has struggled year to date, coming in at a negative 13.42%. Long term is more important, and so since inception, this fund has returned almost 9.5% annually. There are 579 stocks making up this fund. Technology is the largest sector in VV, with consumer discretionary, financials, healthcare, and industrials also making up a large portion of the fund. Apple, Microsoft, and Amazon once again make up the top 3 companies in this fund. Let's hope they do well during the recession. The dividend yield is strong and has produced a quarterly dividend in the 60 to 70 cent range. The expense ratio comes in at 0.04%, meaning that 40 cents per $1,000 invested annually will be paid. All right, there you have it, the 7 best Vanguard ETFs to buy for the 2022 recession. Now, one thing that stands out to me are the incredibly low expense ratios. As I mentioned, Vanguard is known for it, and it's just nice to invest in diversified ETFs with low-cost fees as opposed to single stocks. Let me know which ETF or ETFs you like from this list. There's actually 2 that I prefer over the others, but I'm going to leave that up to your imagination to try to figure out. If you did find value in this video, please smash the like button and don't forget to subscribe. Thanks for watching, and I'll see you in the next one.